Okay, so today we are tackling a name you've almost certainly heard of, but a company that, well, it operates like no other on the planet. Berkshire Hathaway. It's this trillion-dollar giant that seems to break all the rules of modern business. So how does it all actually work? Let's dive in.
To really set the stage, just look at this number, $700,000. That is roughly the price for a single Class A share of Berkshire Hathaway stock. No, that's not a typo. So what on earth is this company?
And that really brings us to the central mystery we're going to unpack here. How in the world did a company that started out as a dying textile manufacturer transform into one of the biggest, most successful conglomerates in history? You know, the answer involves a story of pure anger, a brilliant discovery, and a complete reinvention of what a company could even be.
To really get Berkshire, you have to go all the way back to the beginning. And surprisingly, it all starts with a mistake, a big one. An investment decision that was made out of spite, that just so happened to accidentally lay the foundation for an empire. So, here's how the story goes. Back in 1962, a young Warren Buffett sees what he thinks is a total bargain, this struggling textile mill called Berkshire Hathaway. So he starts buying up shares. The CEO makes him a verbal offer to buy his shares back, but when the written offer finally arrives, it's for a slightly lower price. Now Buffett, he feels slighted, right? But he doesn't just walk away angry. He gets even. He starts buying up more stock and more until he takes control of the entire company. And then he promptly fires the CEO. The only problem? He's now the proud owner of a failing textile business, which would limp along for another 2 decades before he finally shut it down for good in 1985. And what's wild is that Buffett himself is incredibly open about this. He calls it his single biggest investment blunder. He actually calculates that if he had just invested that money directly instead of through this spite purchase, his returns would have been hundreds of billions of dollars greater. So the most important point here is that this legendary company was founded on what he himself admits was a huge mistake. So if the textile business was a complete dud, where did all the money come from? Well, this is where the story gets absolutely brilliant. Buffett turned his mistake into a launchpad by discovering this powerful financial engine hidden inside a totally different industry, insurance.
And this brings us to the one concept that unlocked everything for Berkshire: insurance float. It's actually a pretty simple idea. Think about it. You pay your car insurance premium today, right? But you might not get into an accident for years, maybe never. In the meantime, the insurance company gets to hold on to your money and the money of millions of other people. That giant pile of cash just sitting there, that's the float. For Buffett, this was a revelation. It was like getting a massive, continuous, interest-free loan from the public. And here's exactly how Buffett turned this idea into an engine for incredible growth. Step 1, Berkshire's insurance companies, like GEICO, collect billions and billions in premiums, all up front. Step 2, Buffett takes that massive float and invests it, buying stocks or even entire companies. And then step 3, as claims slowly trickle in over time, they get paid out, but that investment machine, it just never stops running on the rest of that enormous pool of capital. It's basically a self-fueling rocket ship.
All right, so you've got this incredible river of cash flowing in from the insurance businesses. What did Buffett do with it? Well, he went shopping. And in the process, he built the 2 distinct halves of the Berkshire Hathaway empire that we see today. The strategy is basically twofold. On one hand, Berkshire buys entire companies, lock, stock, and barrel. And on the other hand, it acts like this massive investment fund, buying up huge chunks of stock in public companies, but without actually taking full control. It's this diversification that creates a real fortress of value. And the list of companies Berkshire owns outright is just wonderfully random. I mean, we're talking about See's Candies, the insurance giant GEICO, Dairy Queen for your ice cream fix, the massive BNSF railway that moves stuff all across America, Duracell batteries, Fruit of the Loom underwear, and even NetJets, the private jet company. It's this portfolio of classic, durable American businesses. Then, of course, you have the other side of the empire, the public stock portfolio. This is where Berkshire holds these massive positions in some of the world's most iconic companies. They own a huge slice of Apple, a huge piece of Bank of America, and a huge chunk of American Express. And these aren't just small bets. We're talking gigantic, long-term investments in businesses they truly believe in. But what actually holds all of this together? It's not just the money.
It's a corporate culture that is completely unique in the modern world. I mean, it is built on extreme decentralization, a whole lot of trust, and an almost comical level of frugality.
Get this number, 27. That is the approximate number of people who work at Berkshire Hathaway's corporate headquarters in Omaha, Nebraska. A tiny team managing a company with hundreds of thousands of employees and a market cap that's heading towards $1 trillion. The philosophy is just so simple. Buy good companies, run by good managers, and then get out of their way.
And that frugality, it starts at the very, very top. This is Warren Buffett's annual salary, $100,000. And it has not changed in over 35 years. This isn't some publicity stunt, it's the core belief of the company. They don't waste money on corporate overhead, which just means more capital can go right back into that investment engine.
This whole philosophy even extends to the stock itself. The famous Class A shares, they've never been split. And that's because Buffett wants to attract serious, long-term partners, not short-term speculators. To make ownership a little bit more accessible, they created Class B shares back in 1996, which trade at a tiny fraction of the price. That lets everyday investors buy a little piece of the Berkshire magic. And that, of course, brings us to the final critical question. The entire Berkshire Hathaway model, the culture, the strategy, the way they allocate capital, it was all built in the image of Warren Buffett. Now, with his successor, Greg Abel, in place, the whole world is watching. The big question is, was the magic in the model, or was the magic really just in the man? The next chapter for this trillion-dollar anomaly is about to be written.